Hey, friend, welcome back to the Live Off Rents show, where we bring in real estate and other financial experts to build passive income, help you create your dream lifestyle, reach financial independence, all that good stuff. As always, I'm your host, Brian Davis, co-founder of Spark Rental, and I'm on this journey with you. Not only do we feature different passive real estate investments every month in our co-investing club, I am in the trenches investing alongside you guys in those investments. So we also love to bring in guest experts who are doing things that are a little different, a little off the beaten path. Today, I am super excited to be joined by Peter Neill. Peter, welcome to the show.
Brian, it's great to be here. Thanks for having me.
Yeah, so if you guys are not familiar with Peter, Peter is the co-founder of GSP Real Estate Investments. It's a syndication firm that specializes in affordable single-family rental properties. He's raised over $80 million in capital, and he's also worked with multifamily properties, industrial, retail, office, and commercial real estate. So, Peter, let's rewind the clock to the very beginning. How you got into real estate in the first place?
Sure. Yeah, it's growing up, my father was a property manager for CBRE.
Okay.
So that was kind of my first introduction to real estate. It would be 2 o'clock in the morning on with a snowstorm, or the other day here outside of Philly, it was really, really windy and like super windy. There we had some outages and things like that. And like that's something where he would have been a busy day, probably would have been lines down and problems at properties and things like that. So that was kind of my introduction, and I just thought, man, I don't know if I necessarily want to do that or not.
Me neither.
You know what I mean? So it's just like I kind of that was what I thought real estate was, and I ended up going to Temple, and I majored in like media business entrepreneurship. So I thought I was going to be in like the television world and or radio, and do something like that. And I like that. I did a bunch of internships and that kind of stuff, and I certainly like that business. And I just happened to get out of school and ended up taking a job at a distressed mortgage investment company, which I had absolutely no idea what the heck that was when I took it. But I kind of knew it was in the real estate realm. I think that's probably how it was introduced, that it was like a real estate investment company. And as I got into that deeper, and we worked with a lot of accredited investors and raising private capital, and we would go to a lot of different events and things like that. And the CEO and one of the founders of that company was a very active real estate investor that did a lot more than just distressed mortgages. So that was really like my introduction to a totally other side of real estate and real estate investing, and maybe leveraging property managers more than being the property manager or something like
Yeah.
that. So it was quite interesting to me, and I kind of jumped in, full steam ahead, and I never really looked back. I was fortunate to be there for a little over 4 years and learn a whole heck of a lot, and met a lot of really great people in all aspects of the business. And we started GSP, I think a little over 4 years ago now, and just keep moving along. It's a great space to be in, and it's one of those things where I learn something new every day.
It's funny. I too fell into real estate by accident out of school, I was working for a hard money lender, and they were also their main company was a nationwide subprime mortgage lending corporation, which, back in 2003, that was, that was popular, right? That was all
Sure.
the rage. Later it became less so. But yeah, so I hear you 100% on, kind of falling into real estate, and, especially on the mortgage side of things. Not that you were issuing mortgages, but still buying them.
Yeah.
Yeah, it
Yeah, kind of a
sounds very
weird
similar to
way to
my own
get
story.
in. There's like you go on Bigger Pockets and like those places where like a lot of newbie, people trying to get into the business go. It's typically you see like, wholesale, fix and flip, buy and hold, and then, private lending and notes and that kind of thing. I kind of started at the total opposite end of the spectrum, with buying distressed mortgages, and the CEO was doing a lot of private lending and things like that. So it was just like that notes and that part of the business was really my introduction, which was a very interesting way to get into the business, and kind of a little bit different than, the traditional path of, wholesale some stuff, make some money, keep something to fix and flip flip it and then keep something, buy and hold it, and just kind of grow from there. It was kind of a different introduction, and I try not to take it for granted. I mean, I think I learned a lot, and I try to implement it in GSP and what we do, and try to look at things from more of a business perspective than just a regular person investing or something like that.
Yeah, well, I think you're 100% right that coming into this business from the lender's side and having that perspective, it does give you a little bit of more of that 360-degree view of the real estate investing industry. I mean, I still made a ton of mistakes when I first got into real estate investing. Uh, but having been on the lender side for many years and seeing real estate investing through that lens, it has helped me over the years in this industry, and I imagine that it has helped you as well. One thing that's really nice about the note business, and yeah, buying mortgages and buying and selling notes, is how much more passive it is than being like what your father was doing, right?
Sure.
Being out there at 3
Oh
a.m.,
yeah.
dealing with downed power lines or, plumbing problems or,
Oh yeah. Yeah.
yeah. So I love that side of it. I don't want to go down a rabbit hole, but just really quickly, tell us a little bit about your thoughts on the distressed note business and how you guys were approaching that.
Yeah, it's an interesting business, and I don't it's probably not for everybody, it's very much. And when I started at that company, it was a second mortgage investment business. So they were primarily investing in second mortgages.
Wow.
And as the company got larger and as they took more capital in, and the market had changed, I mean, a bunch of different things going on, they transitioned more and more into first mortgages. And they're two totally different businesses. I think that's one thing that maybe some people misunderstand, or the strategies, there's certainly crossover, but for the most part, they're different businesses. So kind of to go off of what you were just saying there, like they used to say with because we did a lot of coaching and things like that, and in my earlier days there. And it used to say, like, with a phone and a computer, you could do that business from anywhere, because it's collections. You know what I mean? So really, it's a collections business, where you're buying, the loan at a discount and then working with the borrower to ideally get them in a payment plan that they can afford, that's going to work for them, that they're going to continue to pay, or you have to exit through the property. And it depends, like you can certainly do that in both sides of the business, where you can exit through the borrower or exit through the property, whether it's a first or a second. But typically with a second, it's going to be more common to exit through the the borrower than it will getting a workout agreement, than taking the property back. Whereas in first, you have a combination. You could certainly buy occupied properties and get a workout agreement. But we in GSP, we have a note side of our business too, and mostly what we buy is HECM loans. I mean, it's like reverse mortgages where the borrower is deceased. So there is no borrower anymore. There's no getting a workout agreement or anything like that. The only exit is through the property. And then essentially it becomes an REO, just, like a bank owned property. It's just not a bank that owns it. And then you do with it what you would any other kind of physical asset. You're either going to sell it at just kind of a just because maybe you bought it at a wholesale price as a loan, you probably got a cheaper price point. So you could just sell it as is, or you could put a little value into it. You could sell it on the market that way, kind of like or you could sell it as like an investor special kind of a deal, contractor special, or you can go in and flip the whole property and flip it off on the market, or you could also keep it as a rental. And I mean, so we tend to look at notes more from, how can we purchase loans that are going to turn into a property that are going to then turn into a rental, ideally down the line. So we tend to go after more of the vacant loans. We don't really necessarily want to be working with borrowers or foreclosures in that sense. And I mean, but so there's going to be different strategies depending on what you buy and then where you're buying the loans at as well, if it's local or if it's more national, and what's your strategy there.
Wow. So we discovered a ton of ground, and I want to.
There's a lot that goes into that. Yeah. Oh yeah.
Yeah, I want to dig deeper into that. So I have not heard of investors going out and buying reverse mortgage notes before. I mean, I'm sure there's a secondary market for it on the corporate level, but I haven't heard of like private equity investors like you guys going out and buying individual reverse mortgage notes. And I guess my first question there is, when I talk to people, like we had Chris 70 on the show a month or so back, and he was talking about how, he goes out and he buys distressed loans at a deep discount. And that's where his protection lies, right? And that's where his upside lies, is he's buying these loans at a fraction of what the original loan amount was, and therefore at a fraction of what the property's worth. But with reverse mortgage loans, since there's no actual monthly payments, how do they become distressed? Or, let me rephrase. How do you buy them at a discount if there's no such thing as a distressed borrower with a reverse mortgage?
Yeah, that's a really good question. And honestly, probably a better question for my partner, Wade, who runs that side of the business. I mean, so we work with a nonprofit partner that has relationships with HUD and different government service entities, and we purchase loans directly through HUD. And they've gone they've gone delinquent for whatever reason. I'm assuming because the borrower is deceased and they're not there to pay. And then the HUD's just trying to get that delinquent product off of their books, so they're willing to sell it at a discount, and then they trade off of BPO value. I mean, so like, what is the property worth versus what's the outstanding balance of the loan? For me, the note business, I have been out of the day to day for it for the last 4 years or so. Really, I mean, with GSP, my focus is on the single family hard asset side. When it comes to the note side of the business, my partner Wade really runs that aspect of the business, and it's his relationships with the nonprofit and the government service entities and things like that. So those kinds of technical questions and all, I would leave. He's better educated than me. I mean, the way for us in GSP is really like that physical asset. You know what I mean? And that's our goal. And through like our funds and things like that is only to acquire the physical assets right now. You know what I mean? It's just I think there's enough demand and product in that space for how much resources and capital we have, that our focus has just been on that side of the business. And then through that vertical with Wade and all, I mean, we have an institutional partner that funds that and all, and it's just a different aspect of the business. But there can be crossover. You know what I mean? The problem and why a lot of smaller mom and pop type investors I don't get into the note space from a property perspective, like the let me go after loans that are going to turn into a property. That's a hard strategy because chances are you're going to be buying loans in a diverse amount of states. You know what I mean? Like, at least for us, like we're buying in large pools. I think right now we own loans in over 40 different states.
Oh, wow.
Yeah. So they're all over the country. So some of the, like, if they're in our markets where we do, hard asset management, property management, physical asset management, like Baltimore or, Maryland and the surrounding area,
That's where I'm
Baltimore,
from.
Philadelphia, right? Yeah, and we're from Philadelphia. I mean, so we're not too far.
Yeah.
So if something fits that, and we have our crews and we can get there and we can manage it, then that's the crossover is great. But there's a lot of other loans that are all over the country that just don't fit. And same thing too, like with our strategy, like the way we buy. We tend to focus on affordable workforce housing properties valued under 250,000. There could certainly be some of that or a lot of that in a note trade that we're doing, but there could be a lot that doesn't fit that as well. You know what I mean? There could be $1 million properties in California. There could be, $400,000, $500,000 properties down south and things like that. So not everything fits the criteria. So the way we kind of look at it is they come in as a loan, we work through them. If it fits the criteria as a buy and hold, or even a fix and flip, something that we would want physically in our territories, then we're happy to go that route. If not, it's going to be exited through other means, which can be value add. I mean, my partner Wade's probably touching 90% of the loans. I mean, I think that's another thing people think like, well, it's all, smile and dial and phone calls and computers. In second space, it probably is, but in first, if the borrower's not able to pay and the workout agreement's not an option and you have to exit through the property, then you're coming back with a physical property. And you could just sell that as is, but you could also add value. We tend to add value in some way, shape, or form. It might be carpet or paint, flooring. It might be minor things, but it also could be full renovations as well. It just depends on the market and our ability to execute in that individual market.
Interesting. So, yeah, I mean, so you touched on a lot there. I want to drill down. A lot of your strategy revolves around holding single family rental properties, and in particular, affordable housing and Section 8 housing. And that is unusual in the real estate syndication space, the private equity real estate space. That's uncommon. We don't see a lot of that. Every month in our co-investing club, we bring in different sponsors and we look at their deals, and we see a lot of multifamily properties, and we see a lot of mobile home parks and retail and that sort of thing. We don't see a lot of single family rentals because it's hard to scale those.
Mhm.
So I guess first tell us why you guys chose single family rentals as a space to be in, as a syndicator, and then how you're able to scale that and make it profitable, yeah, at
Sure.
scale.
What's the movie Taken with Liam Neeson where
Not where I
there's
thought
a
you were going
particular
here.
no, the first thing that came to mind, there's a particular skills that goes into to
Yeah,
why how he does what he does and all that kind
I
of
have a
stuff.
particular skill set.
Yeah, exactly. That's it. I have a particular skill set. That's really what it comes down to at the end of the day. And I mean, like, that's what we're built out to do. That's what we've been doing. My partner Wade, who runs the note side of the business, prior to 2008, he was managing a single family portfolio with over 700 doors. So we come from a very strong single family background of acquiring, at scale and managing at scale, all that kind of stuff. My partner Ron has been a construction manager, general contractor for over 20 years now. Some of the guys on the crew have been with him for 15 plus years. So we're really built out for single family, rentals, for scattered site, stuff at different states, different cities, different streets, different parts of town, all that kind of stuff. Like that's just what we're built to do. We love single family for a lot of different reasons. And I mean, I think there's there's a ton of demand in single family in general right now, whether it's lower end or higher end and everything in between. But for the low to moderate income, the affordable workforce housing, in our areas, properties under 250,000, they're not making more of them.
Right.
And you look at a national scale. I say this all the time. I think it was data that came out a few months ago or so. I think it was a 1 year period, last year at some point where the new homes that were sold, new construction that was sold for over 200 and under 250,000 was less than 4% of new homes constructed. So we're just not building new ones. And same thing too, like we tend to be more in metropolitan urban areas, row homes in the cities, and then the surrounding suburbs of those metropolitan urban areas, and there's just not a whole lot of land left to develop in those areas, so it's the built environment. There's opportunity more for redevelopment, and taking blighted homes that aren't adding any value to a community. They're not bringing tax dollar in, all that kind of stuff. So taking homes like that and then redeveloping them, and then selling them as a home to a first time home buyer. Typically is going to be first time home buyer in the 250 or under range, or selling, keeping them as a rental. Massive amount of demand for those types of single family, affordable workforce, whether it be subsidized or not. Those types of rentals. So we just, as any good investor would, you're going to look at what's the supply and the demand constraints, and where, what does it look like in the areas that you invest in. And that was something that we really saw as a good, had good data and good metrics that said, this is something we should focus on. The other thing too, like as a fundraiser at heart, somebody who, before starting GSP was doing a lot of fundraising. For me, when it came to getting into a new business and starting my own business, I really wanted to be in something that wasn't extremely cyclical. And I think the supply and the demand within the affordable housing space, it kind of insulates it from a lot of this cyclicalness. Because
Sure.
even with interest rates and all, you know what I mean, we've continued to see rents going up. I really like that we're in the areas that we're in. I constantly, you get articles all the time. I'm sure you see these where it's like the top 10 states for, you know, that have the highest rental increase, or, you know, the top 10 states people are moving out of, or the top 10 states people are doing that.
Yeah, it's boom bust kind of
Pennsylvania,
stuff.
yeah, exactly. I mean,
Yeah.
Pennsylvania, Philadelphia, Maryland, Baltimore, they tend not to be on either side of the spectrum. They're not the 10 worst, they're not the 10 best. We're kind of in the middle there. So we don't see those hockey puck type, you know, appreciation, or, you know, those kinds of returns. It's just consistent, you know, it's just consistent returns. And the other thing too is, you know, most of the building boom and stuff like that has been in the multifamily side. You know, we're bringing new units to market in the multifamily realm. They're trying to make up for the massive gap between new housing formation and new housing starts with more and more multifamily properties. And that's good in some ways, but in other ways, you know, you look at data and, you know, polls and things like that. I think it's like 8 out of 10 people would prefer to live in a single family home. And
Yeah.
especially when you're in the affordable workforce housing space, when you're dealing with people who are working, who have kids, you know, who are doing, you know, living that kind, you know, normal lifestyle like that, then they want more space. They want to be in a single family home. It's hard to raise kids in a 1 or 2 bedroom type apartment, which when you look at the affordable, what's available in the subsidized market of that, a lot of the multifamily tends to be studios, 1 bedroom, 2 bedroom. It's difficult to see, you know, units that are much more than that. So there's a very low supply constraint on that. So we
Yeah.
tend to focus on those 3, 4 bedroom homes. You know, there's a ton of demand for it.
Yeah, well, so you're certainly correct that they're just not building very many affordable entry-level single-family homes around the country because there's not that much money in it for
Sure.
developers, right?
Yeah.
You know, there's a lot more money to be made by a developer in either building out a big multifamily complex or building the luxury single-family homes to sell. You know, the
The
profit
build
margins there
to
are a lot higher.
That's why you're seeing so many built to rent communities, you know,
Yep.
and a lot of the institutions have gravitated towards the built to rent communities because like Invitation Homes and some of those earlier, you know, Wall Street backed firms that got into the single family rental space were able to get there buying massive amounts of notes. I mean, they were buying first mortgages and Colony Starwood, which I think Invitation Homes kind of gravitated out of. You know, they were buying, you know, entire neighborhoods with distressed mortgages and then turning them into rentals. Those days are over. You know what I mean? It's
Yeah.
just, you're not seeing that as much. It's more difficult in those kinds of markets to spend the kind of capital they need to spend on scattered site single family. So there's a huge opportunity. I'm seeing more and more funds come out that kind of work with institutions that put together, you know, smaller type scattered site portfolios, maybe 100 to 300 some properties or so, and then an institution will buy them at that scale. But for the most part, you know, institutions need to deploy 50, really $150 million and up.
Right.
Buying a huge tract of land down south and developing built to rent communities, I think is a much more efficient, you know,
Oh,
it
yeah. It's
just
much
it's
easier to
more
do at
in the,
scale.
yeah, much easier to do for them to do,
Yeah.
for them to do that. But which kind of comes back to your question too, like on, you know, how is it managing single family at scale and things like that. That's, I think, one of the biggest misconceptions with investors. I think it's actually easier to manage a single family portfolio when you have efficient scale. So you're gonna, you know, I think a lot of times smaller mom and pop investors, as they get larger, they find it more and more difficult to do things because they're doing everything themselves, and it might not justify strong hires quite yet. You know what I mean? If you have 20, 30, 40 properties, you know, could you really justify a handyman for that? You know what I mean? Somebody
A
who's going to be,
full-time,
you know, full
yeah,
time
worker.
staff.
Yeah, yeah, yeah.
Exactly. You need, you know, 200 properties, you need
Hmm.
300 properties, you know, you need other things. I mean, for
All in
us,
one location too. Yeah.
Exactly. Yeah, and the scale with scale in the single family space actually comes those efficiencies and the economy of scale that's created. If you can expand, like if this is your business, you know what I mean, you can also, I mean, we leverage the construction side of our business a lot. I mean, that allows us to have a large crew that's constantly working for us on a daily basis.
And that must be local
And
then around Philadelphia.
yeah, yeah, exactly. So we do a lot of, kitchens and bathrooms and, we do residential type work in that space, some small commercial work. We work with other investors. Primarily, we like to work with other investors
But
to
how do you
keep our crews
scale out of
busy, all that
state
kind of stuff.
with these scattered site single family rentals?
Sure. So for us, in Baltimore, we started with, we have a very strong network that want to work. You know what I mean? So these guys, they don't necessarily care where they're living, especially if they don't have a family and kids and that kind of thing. Like they will uproot and they'll move if they're able to work and work all day, every day, that kind of a thing. So we started with our crews in Baltimore, and that's not that far for us either. You know what I
Yeah.
mean? And if you leave in the morning, you're there hour and a half. Yeah, I mean, maybe not even. It's a pretty quick ride. So, and if you leave late, early enough in the afternoon too, and like that 3 o'clock range or whatever, it's an hour and a half back too. It's not that bad. You kind of miss the work traffic. So we started with that, and then we were fortunate to get a partner down there on the construction side who he has everything, the license, all that kind of stuff that you need to operate in the city. And he has a massive crew that he can scale up and down and does a lot of work. So he's kind of our eyes and ears and boots on the ground, all that kind of stuff in the Baltimore market. And then we kind of have our like project managers, you know what I mean? So we're on site managing him and managing his crews and that kind of thing. So as you get larger, I think managing the managers is a very important, it could be a very good way of setting your business up. And I think that's why you tend to see a lot of people go towards the multifamily and the self-storage and those types of investments, because it can be one person or it could be a small team, and they're with the scale with a 200 unit complex or something like that, it can justify good property management, maybe construction management, or maybe the property management firm handles that. And then they're having their weekly management calls and things like that, and they're managing the managers. It can be similar in this space as well, but you just need to have that scale. And it's something like for us, I mean, we started small. I mean, when we moved into Baltimore market, I think we bought a triplex, and then a couple scattered site properties, and it just continued to move up there. And it's just kind of one of those things where you keep doing it, and it kind of snowballs over time. And you know
Yeah. Well, that's certainly an interesting niche that you guys have chosen, and one that I'm guessing there's isn't nearly as much competition in, because that's such a challenge, right? Being able to
Sure.
scale in multiple markets at the single family level. So I want to be mindful of your time, but I've got one last question that I have to ask you, as someone who has owned a couple Section 8 rental properties in Baltimore myself.
Sure.
One of the challenges that I saw both with my properties and with other people who were managing single family Section 8 properties was the annual inspection, and how inspectors would prove to their supervisors that they were actually hitting every property on their rounds by failing every property basically, and writing them up for a bunch of
Sure.
repairs for each property, whether they needed them or not. So that is constantly adding on repair and maintenance work every year, whether or not the property actually needs it. So how do you guys, and usually those repairs, they would eat up the entire cash flow for the year. So how do you guys
Yeah.
circumvent that problem?
Wow. That specific problem has not been something that we have found, as like the norm or something like that, or it's systematic throughout the portfolio, that kind of thing. A lot of what we do is like full renovation. I mean, so we're buying properties that we're going in, is taking it down to the studs and rebuilding. So we're practically handing over new construction to the tenants. So at that stage of the game, we tend to not run into too many issues there. You know what I mean? And we've been doing it long enough where we know typically what the hot button issues are. We're fortunate too with our contractor down there who has grew up in Baltimore, has been in the Baltimore market for 30 plus years. I mean, he's got a lot of connections and things like that. So he kind of knows how to play the game and navigate the system
That
and
helps.
that kind of thing. I think that's really an important aspect.
Yeah.
But and two, I think maybe over the years things have changed. And I mean, or some inspectors are better than worse, and or better than others, that kind of thing. But for the most part, I think the city understands there's a massive need for affordable housing. That they don't want to make it too difficult for somebody to come in and operate. You know what I mean? But at the same time, there's always a piece of they'll treat you the way that they you'll treat people the way that they treat you, kind of a thing. You know what I mean? So if you keep the properties well, if you're handing over new construction, we're buying in the same areas over and over again. So we're doing semi-annual inspections and things like that. We're in the properties on a regular basis with other little maintenance things and stuff like that come up. So we kind of know what it is that they're looking for, and just kind of deal with it from there. And sometimes too, it's better to maybe eat that inspection fee, but let them tell you what it is they're looking for, instead of going in and making assumptions, that you're going to have, they're going to do this and do that and do this. But they see a cobweb and they want to come back. And I mean, we've
Right.
certainly experienced that before. But overall, I think it's like anything, you just have to know how to play the game, and you have to, you make good connections and you treat people the right way, and you do business the right way, because I think they probably see a lot of slumlords, who just aren't keeping the properties well. Their finishings and their construction work is not what it should be, that kind of thing. So maybe they tend to do that kind of stuff on that side of the business, but a little bit of a relief when they deal with somebody who's doing things the right way, who cares, and ideally did things right up front. You know what I mean? So that comes back to too, as an investor, if you're buying right and you can hand over new construction, that is certainly a great way to do it. You know what I mean? We tend to stray away from the value adds, which is funny. Like some of the wholesalers, that we work with, the real estate professionals with off-market deals and things like that, they'll say to me like, "Oh, well, I don't know if you'll like this or not. It's a $20,000, full gut, needs a full renovation, that kind of thing." It's like, no, that's what I want. Because and it's like, what do you mean? Like, why would I like that? And they're like, "Oh, well, we tend to see investors that they want more of the value add." You know what I mean? They want something that's 70, 90,000. They can come in and put 20,000 into and all. Like that's typically when you're going to start to run into issues. And as a tenant's living there, they're going to find out what the issues are and stuff like that. So that's why we like more of the full renovation stuff.
All right. Well, Peter, if people are interested in investing with you, with GSP, how can they learn more about you and what you guys are doing?
Sure. So our website would be the best place to get started, gsprei.com. We do, we have information on our funds there, all of our info, management team info's there, they could schedule a call and stuff like that. And then I would say, like, don't hesitate to reach out. I'm always more than happy to have a conversation. And, I'd like to better understand what your goals are and what you're looking for and how we can maybe help that. I think the percentage of subsidized housing within our portfolio is a really big differentiator from a lot of other funds that offer similar, types of structures and things like that. So it's, I would say, like, let's just have a conversation, and start on the site and take it from there.
Well, we certainly hope to be able to work with you guys in our co-investing club in the coming months. So, Peter, thank you so much for coming on today. This was a lot of fun.
Yeah, it was a great time, Brian. Awesome conversation, and looking forward to staying in touch with you and hopefully talking to your audience.
Yeah, well, guys, if you enjoy these conversations that we're having, please rate, review the show. It means the world to us, and we will catch you next week, same place, same time. Have a good one.
Like the idea of diversifying into real estate, but don't want the headaches of being a landlord? Enter passive real estate syndications. You buy fractional ownership in apartment complexes and other large-scale properties. Earn your share of rental income and your share of the profits when the property sells. In fact, most of the syndicators we've invested with have averaged returns over 20% per year. You even get full tax benefits, including accelerated depreciation. Even as you collect distributions in real life, you often report a loss on your tax return. So why doesn't everyone invest in real estate syndications? First, you typically need to know the syndicator to invest, and the minimum investment for each property is high, usually $50,000 to $100,000. That's a lot of money for a single investment, which is precisely why we formed an investment club to pool funds and invest together. Every month, we propose a new deal in the co-investing club and vet it together on a group call with the syndicator. Each deal is purely optional. Pass or invest as you like. As for us, we invest our personal money alongside you in every single deal. If you want to invest like the 1% without actually being a 1%er, join Spark Rental's Co-Investing Club. Email us at support@sparkrental.com with questions, and we look forward to investing alongside you.